China's making sure that they can track and trace basically all the silver flowing out of China. But it is not stopping the flow out of China. And the 140, maybe 200. The government of the United States probably would not have a number. But Michael Oliver really lays it out succinctly, that does the momentum analysis. And he talks about the acceleration phase and a repricing of silver. We could get to 100 or maybe 200 or maybe more. We've got, at least 10 years to go because of the deficit that won't be solved probably for 10 more years unless there's a huge technological breakthrough of some type where Samsung is provable, going to the silver belt from Chile all the way through Mexico. Tesla out there, everybody knows that. It says, I need to secure a good solid silver supply. I'm going to buy a silver mine rather than go through the exchange.
Companies in India and China are reaching out even to silver juniors.
People say, we'll quit exporting our silver. I almost had to throw out my Coke. I was coughing so loud because one is I wrote an open letter to Elon Musk a few years back about the silver situation and why he might want to consider, buying physical silver and or a mining company. As far as Samsung is concerned, I kind of laugh in a way, and it's not funny, but one of our key picks in our more speculative side in the Morgan report was Avino Gold and Silver. And I've known David Wolfen for years. In fact, I knew David Wolfen's dad. And anyway, the point is that Avino had an offtake agreement with Samsung. It's probably at least a decade old, Charlotte. So one of the few, and it's in their reports, and David and I would talk about it from time to time, that was a forward-looking electronics firm that understood the significance of silver and securing a direct supply early on. So this one that we're talking about is one that's just, as far as I know, a secondary source that they have added to it. And lastly, on top of that, I've not been there and witnessed it, but these sources are so solid that I am convinced that there are some Chinese that are looking in Peru to secure silver either in doré or concentrate form before it's put on the free market, we'll say. So I think there is more to that than a rumor.
The quiet story here isn't Elon Musk. It's how supply chains are being locked up before markets even see the metal. David Morgan points to Samsung's decade-old offtake deal as proof that smart industrial players secured silver long before today's shortages made headlines. Global silver deficits have now persisted for 5 straight years, according to industry data, yet retail investors are still reacting instead of positioning. This isn't about speculation. It's about preemptive control of inputs, the same way energy majors lock in long-term fuel contracts. For investors, this signals that upstream miners with real offtake agreements may matter more than spot price moves. What David Morgan hints at next reframes silver not as a trade but as infrastructure.
Samsung is provable. The going to the silver belt from Chile all the way through Mexico is verifiable. And I think you're going to see it continue because once a large entity, such as, we'll just throw Tesla out there, everybody knows that, and says, I need to secure a good solid silver supply, I'm going to buy a silver mine rather than go through the exchange or refiner. Once that takes place, you'll see, I think, more of it take place. So what I'm suggesting is that Samsung's already done it and is continuing to do so. You might see others emulate that kind of a thing. And also, just to stockpile the raw silver, that's the product that they all need. And to look ahead and see, we've had a deficit for 5 years perhaps, and we have a deficit at least going out 5 years in the future. Even with a major recession, there's still so much of a build out in the electronics world, AI and data centers, and need for electricity and even infrastructure repair for a lot of the grid in North America, that you could have a recession and still not slow down the need for silver. And actually, if there's a recession, it'd be a boost to silver primarily because copper mining, which is 27% of the silver market, comes from copper mining. If that's curtailed because of a big recession, you actually tighten the supply of silver, not actually open it up.
This part quietly dismantles the recession kills metals narrative Wall Street keeps selling. David Morgan highlights that roughly 27% of silver comes from copper mining, meaning an economic slowdown could actually reduce silver supply instead of demand. Meanwhile, AI data centers, grid upgrades, and electrification projects continue regardless of GDP prints, something the IMF itself flagged in its 2024 infrastructure outlook. Corporations don't wait for spot markets when inputs are critical, they buy mines. Investors chasing recession fear may miss that tightening supply during downturns has historically fueled metal repricing. What David Morgan lays out next challenges how investors think about economic slowdowns entirely.
Yeah, great point on the recession and copper mining as it relates to silver. And just another related point that I've seen questions about from our audience. During this silver frenzy, we've started to hear that companies in India and China are reaching out even to silver juniors, so companies that aren't producing silver at the moment, and talking about trying to secure supply from them. So is that something that you've been hearing about? Is there truth to what's being said there?
There is truth to it. Yeah, there was an interview. I forget who did it. I give them credit. I think it was Kuna Silver, and definitely that's been verified by two CEOs in the mining business. I trust them both explicitly. They wouldn't lie to me or the public. I mean, they're good guys, and surprisingly, in the second one, there was a bid spread between the current spot price and what this approach was willing to pay, which was substantially above the spot price. And that's what I've always thought. And I never was able to get the exact contract out of David Wolfen. It's private. It's a business deal. But I did allude to the fact that it would be something like the spot price plus 5% based on the average spot price per quarter, something like that. In other words, if I want to secure a deal and make it friendly, I would be paying the bare minimum silver price on an average basis, because you can't trade it every day.
This is where paper pricing quietly breaks down. David Morgan confirms that real-world buyers are offering premiums above spot to lock in future supply, something futures markets don't reflect. When juniors with no current production receive inbound calls from Asia, it signals desperation, not speculation. Historically, sustained spot premiums, like those seen in uranium between 2018 and 2021, preceded multi-year repricing cycles. For investors, this matters because spot charts can lag reality by years. Long-term contracts, not daily prices, drive industrial decisions. What David Morgan explains next shows how pricing power quietly shifts away from exchanges.
Buying a long-term contract, but I'd sweeten the deal. I'd say, okay, if the average price is X, I'm going to pay you X plus 5%. That way, we've got a deal that's going to be locked in for years, a decade, or it's a life of mine or whatever. And both sides are happy, and they gladly pay, an extra 5%. I'm just making up that number. I don't know even if that exists. That's the way I would write the contract. The idea being that I've made a secure investment for the ongoing business activities that I have to maintain.
That's really interesting to get your take on that. So thank you for going into it. On the note of China, I also wanted to raise the point of these export controls on silver. So there's a lot of questions surrounding that and how impactful it could be to the market. How would you put it? Is this going to be significant for silver?
I'm not going to call it nothing burger, but I do think it's overdone. I did speak with Mike Dorenzo, and I know he's popular and unpopular, but I've known Mike from almost day one when I started on the internet with the Morgan Report. And I didn't get a lot of new information out of Mike. But from what I've been able to determine reading what it says, trying to take it as factually as I can, it's overblown.
This is how real commodities are priced, quietly, contractually, and far from CNBC headlines. David Morgan explains that buyers willingly pay above average prices to eliminate uncertainty, not chase upside. Meanwhile, China's export controls dominate headlines, yet most refined silver flows under long-standing agreements that don't suddenly disappear. The World Silver Survey shows over 70% of silver moves via pre-negotiated channels, not spot markets. For investors, panic over policy headlines often masks the stability of industrial supply chains. What David Morgan points toward next reveals why control matters more than control headlines.
There's already agreements in place with like the big exporters. They're just making sure, China's making sure that they can track and trace basically all the silver flowing out of China. But it is not stopping the flow out of China. And this is what I discussed with Mike. And that is, if I'm XYZ mining in Peru and I ship over my concentrate to be refined in China, which by the way is about 60% of all silver refining, I'm going to get my product back. It's a deal's a deal, and they're not going to mess that up, at least in my strong view. Now, as far as what the outflow is, will it be different than the original contract? Probably not. But if there isn't a licensing agreement with the exporter, there will be one now. And I think it's really just more to get a handle on what the flows are in and out than stopping silver flows to the West. And I want to go one step further. It may be in your question deck. I'm not sure, but people say, well, let's, we'll quit exporting our silver. I mean, I almost had to, throw out my Coke. I was coughing so loud because, first of all, going back into the Silver Eagle program, this sounds off base, but we'll get into it and make a real important point.
The headlines scream export controls, but the machinery underneath keeps moving uninterrupted. As David Morgan points out here, roughly 60% of global silver refining still runs through China, meaning existing contracts matter more than political noise. Tracking and tracing sounds restrictive, yet history shows commodities rarely stop flowing when industrial demand is intact. The market forgets that long-term supply agreements override short-term policy optics, much like oil sanctions quietly reroute barrels instead of eliminating them. Investors reacting emotionally risk mispricing miners, tied to stable refining channels. What David Morgan explains next exposes how little silver the West actually controls.
When the strategic stockpile was used to build the Silver Eagle program, after they ran out of the stockpile, the legislators, when they enacted the Silver Eagle program, said we can only use domestic silver in the production of our U.S. coins. Well, they found out in a big hurry that we don't mine enough silver to even keep up the Silver Eagle program, let alone all of the electronics that passes to the United States of America. It was ludicrous. So they immediately changed the bill, and so we could source silver from anywhere we could get it to make the coin program. Well, the coin program on a good year is 40 million ounces, which is a pretty fair amount of a pressed coin from the government. But it pales in comparison to the industrial need of silver of like 500 billion ounces per year. So I laugh because to restrict the amount of silver going out of the United States from domestic production is such a pitifully small amount. We're in the opposite of the driver's seat. We're kind of the beggar saying, please, 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 can I get silver from anywhere? So I just want to set the record straight on that one.
Yeah, that's great to go into. And it does tie into where I wanted to go, which is, I think since we last spoke, silver's been added to the U.S. critical minerals list.
This is where national security narratives collide with basic math. David Morgan reminds us that even at 40 million ounces a year, the Silver Eagle program is trivial next to massive industrial demand. The US learned quickly it could not rely on domestic mining, a reality that hasn't changed despite policy language. Investors should notice how often strategic labeling masks structural dependence rather than control. When supply chains rely on imports, restrictions become symbolic, not practical. What David Morgan points to next shows how policy recognition can still reshape demand.
So I was going to ask you about the significance of that and what it could mean for silver mining in the country. Do you think it actually makes an impact?
Absolutely. I think it will. It really depends on the flow rate. I mean, the silver strategic stockpile when we went to the Silver Eagle program was 139 million ounces. Based on the petroleum reserve, the strategic petroleum reserve, and looking on a per capita basis, I would guesstimate that we're looking at least 100 million ounces of silver needed for the strategic stockpile. Maybe the 140, maybe 200. I thought the government of the United States probably does not have a number right now, but let's just use that 100 million talking points. In that case, the average retail purchase of silver on a physical trajectory is about 200 million ounces a year. So if you added 100 million in 1 year, which I think is reasonable, could be 2, could be 5, I don't know, could be 3 months, I don't know. But if it was 100 for the year, you're adding about 33% additional physical requirement on top to what's already an average offtake, which of course we're above average in offtake now. Not only North America wise, I'd have to look at the numbers. We don't have them yet.
The critical minerals label quietly introduces a new buyer into an already tight market. As David Morgan outlines, even a conservative 100 million ounce stockpile would add roughly 33% to annual physical demand. That's not speculative demand. It's institutional accumulation, similar to how central banks steadily absorbed gold after 2009. Markets often misjudge slow-moving buyers, then reprice suddenly once flows become visible. For investors, this shifts the risk from price volatility to availability itself. What David Morgan highlights next connects this demand shock to retail behavior.
But I suspect here forward, 2026 onward, I think there are going to be a lot of retail comes back into the market at 70 and 75, believe it or not, because where else are you going to go as the empire starts to crumble more and more? And, what just took place in Venezuela is an absolute verification of the two books called Resource Wars. So I'll give it back to you, Charlotte.
Retail usually arrives late, but history shows it arrives forcefully when trust erodes. David Morgan suggests higher prices won't deter buyers if confidence in currencies continues to slip, something Venezuela's collapse illustrated painfully. In prior cycles, silver demand spiked after price doubled, not before, because fear overrode price sensitivity. The danger for investors is assuming retail exhaustion when structural distrust is growing. Silver becomes less about returns and more about insurance. What David Morgan says next reframes silver as a response to systemic breakdown, not speculation.
Typically, we hear in these precious metals bull markets, gold moves first and then silver follows, and the silver move is toward the end of the cycle. But it doesn't really feel like we're toward the end of that cycle right now. So where would you place us?
Well, I'm trying to really, this is like the hardest job I have in my own opinion. But, I've been pretty much on the mark all the way up. Certainly I called the tops. Certainly haven't been the best bottom picker. I admit that. But, I think the long-term picture I've been as objective and as accurate as anyone. I mean, I don't know how many times I said over the years, and you've known me for years. If you could buy silver long-term under 30, you're going to be very happy. And I think anyone that bought silver US 30 or a Canadian 30 is pretty happy right now. So I think we're going to continue, to see that. So in the cycle, I've said for years, 90% of the move in the last 10% of the time, and I still believe that. We are in the acceleration phase of the cycle. I would argue anyone that we're not.
This is a calm bomb moment because the usual late cycle silver move narrative no longer matches the price behavior we're actually seeing. As David Morgan frames it, silver holding above the $30 zone after years of resistance signals structural strength, not exhaustion, especially when prior bull markets saw far sharper pullbacks at similar stages. Historically, silver's largest percentage gains have clustered into compressed windows, like 1979 to 1980 when it tripled in under a year, supporting the 90% move thesis. If this is acceleration, investors need to rethink position sizing, volatility tolerance, and exit discipline rather than waiting for confirmation headlines. As David Morgan hints, the risk now isn't being early, it's being underexposed.
I mean, you look at one of the more prominent analysts in our sector now that does the momentum analysis. He's phenomenal, and he talks about the acceleration phase and a repricing of silver, and he's absolutely correct. And I do think that we could get to 100 or maybe 200 or maybe more. I don't know. The market knows more than any of us. But Michael Oliver really lays it out succinctly and, just a very good student of the markets. And And Mike Oliver just goes through why you could see this acceleration that no one expects. So that's it. That doesn't negate my overall thesis, meaning that if we have a 25-year bull market and we're in the last 10% of the time, that's about 2.5 years. And you want to count the gold breakout at 2000, and I don't have the chart in front of me. Maybe that's the start of it. Maybe we only have a couple years from there. Now, people argue fundamentally, well, David, you're out of your mind. I mean, anyone, the student of silver that you are, should know we've got, at least 10 years to go because of the deficit that won't be solved probably for 10 more years unless there's a huge technological breakthrough of some type where, there's a meteorite, pure silver, that's as big as Africa that'll land or something. Sorry for my sick humor. But I agree with that analysis based on the status quo.
This is a classic market mirage where upside targets grab attention, but time compression is the real story investors miss. As David Morgan acknowledges, momentum analysts like Michael Oliver aren't predicting gradual appreciation. They're warning of violent repricing phases that historically ignore fair value logic. Silver's supply deficit hasn't stopped prices from stagnating for years, which tells you paper positioning and liquidity cycles matter more than fundamentals until they suddenly don't. If the gold breakout near $2,000 marked the clock start, investors may be debating price targets while ignoring calendar risk. As David Morgan subtly implies, being right on direction but late on timing is how capital gets mismanaged.
But one of my main themes isn't just, the precious metals. My underlying theme of the Morgan Report is money, mining, and markets. And the money equation is, what are we doing with the money, which is a falsehood. Everyone knows it at this point, at least anyone that tunes into INN. And they're going to realize we are looking toward a new system. And the new system exists. It's existed in China for quite some time. And believe it or not, it works quite well. So I do believe that's where we're headed. So because of that strong conjecture on my part and others, I think this market does only have a few years left. And what do we do during the transition? I really don't know. Obviously, we know silver, gold, platinum, copper, lithium, everything that you do at INN, including the energy markets, are extremely valuable. This is what makes the world go round is the energy sector and hardcore commodities. So those won't go away. It's just how will they be repriced in the new system? And that I really do not.
This is a policy red flag because it shifts the discussion from metals to the credibility of the monetary system itself. As David Morgan points out, capital doesn't flee into commodities randomly. It moves when trust in money breaks, and global reserve shifts have accelerated since 2018. China's system prioritizes control and resource security, while Western markets still assume infinite liquidity and stable pricing, a mismatch investors underestimate. For portfolios, this means commodities aren't just inflation hedges, but transition assets during systemic resets. The uncertainty isn't whether metals matter, but how violently they'll be repriced. As David Morgan suggests, the next phase won't reward complacency or linear thinking.